Welcome everyone to another Bitguide session. Hi Sina. Sina has joined me for another session here. How you doing?
Hi everyone. Yeah, I'm doing great. Let's have another great chat.
Awesome. Yeah, today we're going to talk about a very, very interesting topic. It's something that has been going around the market news for quite a while, and a lot of investors are concerned about it. So, we're going to talk about the interest rates and their effects on the markets as the Federal Reserve or Central Bank of the US has decided to increase interest rates. I think this is a very, very relevant topic, not only on the stock market, but also on the overall commodities market and, of course, Bitcoin. So, today we are going to go through a few basic stuff about the interest rates in general. What actually is it? How is it determined on the free market versus on the quote unquote central bank manipulated market, and how the effects are on these other types of assets. So, but before we go ahead, I would like to just mention one more time what we do here in Bitguide. We offer educational content and soon also courses. And you can follow us here on Clubhouse, on YouTube, and on Twitter, and you can give us a follow. So whenever we do these rooms or whenever we do these sessions, you can follow us and get a notification whenever we do them. And of course, our podcast is also available on Spotify currently and very soon on Apple as well. And we do this every Wednesday at the same time. It's 6:15 Central European time. What time is it in your time zone, Eastern time right now, Sina?
It's 1:20 Eastern daytime.
Yeah, so 1:15 Eastern time, 6:15 European time. That's when we try to do it. But even if you cannot listen to us live on Clubhouse, you can listen to the recorded sessions. And of course, you can also watch us on YouTube if you like. So, Sina, why don't we go ahead and talk about this interesting topic? I think we can start with interest rates in general. Maybe we can talk about interest rates on a free market, how they're actually determined, and then we can move forward and talk about the Federal Reserve and how the Federal Reserve tries to basically use this specific rate to increase or decrease productivity and the economy.
Sure. Yeah. I mean, it's very important to make sure we understand what's going on exactly, and what are the things that impact market movements and why. So that's what we will hopefully do today. So let me start with the concept of uh, interest rate that we're talking about. There are many different interest rates in the economy. The one we are mostly focused on, and when people talk about rate hikes and all, that's the federal funds rate, which is a very, very specific type of rate that we will talk about. But for the purpose of this beginning discussion, we can think of uh, a general or aggregate interest rate in an economy, which will emerge in the absence of a central manipulator like the Fed. It will emerge naturally by the action of market participants. So how it should naturally work is a process like this. First, you and I, we go to work. As part of our work, we produce valuable things for the economy, valuable goods and services. And we get a wage. Then we have a choice what to do with that wage. Some of it will be spent on the market. So some of the products we have created will be bought by other people, and what other people have created will be bought by us and consumed and out of the market. But some of that cash that we collect gets accumulated. Particularly the people, those parts of the economy that have the highest time preference, lowest time preference, they would be basically foregoing immediate consumption for accumulation of wealth.
Savers
So
in that case.
exactly, the savers in the
Yes.
economy. And
Yes.
what they will do is basically they will go to work every single day. They produce valuable goods and services for the economy, but they consume nothing. So intentionally, they benefit less. They enjoy life less intentionally because they are calculating that in the future they're going to be able to consume a lot more after that the capital they accumulated pays off and turns into something much more valuable than immediate consumption. So these people accumulate wealth, and that's what we call capitalism. Capitalism is not about consumption, it's about accumulation of capital. So,
Mhm.
so then you get a situation where there's a lot of products in the market, and demand for those have declined because a lot of people are, or some people are savers, and the price of those goods would fall, and this will create input prices for companies. Create the opportunity for companies to use low input prices and benefit in terms of better margin, more opportunities for starting new companies and all. And then this accumulated cash finds its way into financial institutions. So maybe when you deposit your cash into a bank, or maybe you personally decide to lend it to someone, which happens a lot less often. Um, uh, whichever route the money takes, the accumulation of money would find itself into funds that will be used to give loans to entrepreneurs, and that's
So the
how savers
saver
get.
so the economy basically through these savers is able to borrow and produce with that borrowing and provide services to the same economy through that borrowing.
Absolutely, it's a good way to put it. So, savers fund future growth of the economy.
Mhm.
So, yeah, and in this condition, there would be a lot of funds available, depending on how many savers you have. So more funds available means the more appetite for lending out the funds. In other words, rates decline, loans will increase, but only to the extent that people have saved before. So because of saving, you have added a lot of goods and services in the economy. Now prices have dropped, and there's a lot of funds to give entrepreneurs. Once those entrepreneurs receive the funds, they will go into the market and buy those excess and unused products and services to do something else with it, and supposedly produce more valuable things. If the lender has done has vetted the entrepreneur properly, the projects will be value adding. In other words, they will be able to produce a lot more goods after they bought the inputs and after they paid back the interest. They will still generate additional profit for themselves, and that's how this accumulation of funds leads to really useful investments that grow the economy. So that's a
So,
natural
so,
process.
so I think the key part takeaway from this discussion right now is that on a free market where interest rates are not determined by any one entity, but rather by a lot of market participants, goes down once there is more savers, and it goes up when there is less savers. So if there is less capital within that economy or less money supply, then therefore it's going to be more expensive to borrow. Obviously, if it's more scarce, it's going to be more expensive to borrow money and to pay it back in return in the future. But if there is more capital, if everybody is wealthy and there is a lot of lending in the economy, then the interest rate goes down quite naturally, because there's a lot of people who want to lend their money, and not because they're interested to not only save for their future, they want to also uh, charge some money on top of that, to have some yield on top of that, with the least amount of risk possible. So instead of going to invest it in the stock market, let's say, they lend it out and they get a fixed rate for a certain period of time.
Exactly, and this is like a self organizing process where um, after you lend out a lot of money to entrepreneurs, well, you have less funds available, so naturally interest rates would go up, and new entrepreneurs would have a harder time to prove themselves to banks and other institutions that, hey, this project is actually worth being funded, and the hurdle rate will be higher. And also, as saving in the economy goes down for whatever reason, let's say some war breaks or whatever happens, when saving goes down, less funds will be available, interest rate goes up. So we will be a lot more careful with the funding naturally. So only projects that are highly profitable will get started, because there isn't sufficient goods available in the economy. So this kind of finds its natural balance, and the interest rates would basically vary depending on the economic conditions, and find the equilibrium itself. But now what we've done in early 20th century is we have created this central bank called Federal Reserve. It's supposed to be private, independent institution, but it's probably one of the most powerful institutions in the world. They have the power to determine value of money. So they will set this thing called federal funds rate. And that's basically the rate at which banks lend to each other overnight. So they have created this repo market where banks that are in need of extra cash, or they have too much cash, they would basically lend that to each other. And the rate of that is determined or kept in a predetermined range by the Federal Reserve. And so that's very short-term borrowing, and it's specifically about bank-to-bank relationships. It's not about necessarily bond yields or any other parts of the economy, but it kind of ripples through every aspect of the U.S. economy and the world economy once they change that rate. And the idea is that, Federal Reserve would hire a lot of analysts and would analyze a lot of data to supposedly find the best number for that interest rate. And if anything, every year we are discovering that they are horribly bad in making decisions, even to the extent that everyone, I mean, there is no, no one that says Fed acted soon enough. Basically, even Fed presidents and members, they're also FOMC members, also saying that we were too slow and we got it wrong. We had lots of PhDs, and we analyzed a lot of data, and inflation should not have been this high. That's exactly what Jerome Powell said last week, or actually maybe on Monday. Yeah, it was on Monday. They had this economic conference where they were like, our models say that inflation should not have been this much after the QE program that they launched after COVID. But inflation is much higher. Therefore, in his argument, something else like a supply crunch or basically supply chain breakdown was the cause of all the inflation we see. That's how they understand it. Of course, models being wrong is never an option.
So instead of letting the market decide what the rate for the available money is, they basically say we can play God and we can determine the rate for the market, and we can basically determine or help or stabilize the economy by changing that rate in the economy up or down, right? That's the concept of
Yeah,
central
yeah.
banking, basically.
I mean, decades from now, people will be laughing at the situation we're in. Every 6 weeks we have to wait and see what a small group of people and bankers who don't necessarily act for the good of the people, what will they decide about the value of money? Instead of letting the market do what it always does to balance supply and demand, in which case supply and demand for funds and money, we are just waiting for someone to tell us how much our money should be worth, and there's just no words that can explain how distorted this situation is. And I'm pretty
Hmm.
sure this is going to change, but like after having caused a lot of damage.
Yes.
So and
So
I
so
guess the
how does it
natural. Go ahead.
yeah, how does it exactly work? Maybe we go a little bit to the mechanics of what they do exactly, and what role do the banks play in this, and where does the money that they provide to each other end up, and how does it affect the markets? And then we take it from
Okay.
there.
So, at the highest level, to put it in the simplest form, once banks are increasing the rates, uh, basically depositing money at banks is going to be very attractive because the rates are higher. So you get compensated more. So naturally, you will find a lot of money that was somewhere else in the economy would find its way into the banking system and would get parked over there. That basically means, high rates also means that we will give fewer loans to entrepreneurs because now rates are higher, obviously, and fewer projects would basically qualify, and the hurdle rate for a project to make profit is higher. So money supply goes down, and money will be moved from other parts of the economy into the banking system, and fewer projects will kickstart. That translates into economic recession, slowdown, increased unemployment, and sell off in financial markets like stocks and uh, and the bond market. So that's basically the high
Hmm.
level of the effect. But maybe more specifically, once the overnight rate goes up, um, banks, obviously the cost for bank operation goes up, right? So they can't keep offering the same low rates to individuals because they are borrowing funds at a higher rate from peer institutions. So they naturally raise the rates for loans to regular people. Um, and that obviously that has the effect of attracting more funds and giving fewer loans. And then what happens is basically, especially in the bond market is bigger than the stock market and generally smarter and faster to react. So what they will do is, a bond player would basically see that now, the banking system pays more interest if they deposit their funds in there instead of lending the fund to the government, which is what basically buying treasuries do. So that becomes more attractive. So naturally, marginally, some portion of the market sells the bonds and moves that money to the banking system or some other place, and the price of the bond falls, but the rate of the coupon payments of bonds are fixed. So as the price of the
Hmm.
bond goes down, the yield goes up. So naturally, you will see that as the federal fund rate goes up, all bank loan rate goes up, but also every bond yield goes up as well. Although depending on the maturity, the effects are different. Shorter maturity treasuries go up faster, kind of they follow Fed funds rate a lot better, and longer ones less, but generally they're highly correlated. And for the same reason, stock market also sells off. Uh, and basically that's what has been happening since last November,
Yeah.
starting with Bitcoin, and then moving on to higher risk markets, and then the bond market and all.
So what happens, just to summarize, what happens is once they determine that money is cheap, they determine that not for the population, but for the banks. And the banks can decide who gets that cheap money, right? And they, of course, are not interested to lend that cheap money to people or high risk market participants. They would rather lend it to each other, or even better, to very, very high level um, exchange listed companies, right? So instead of the money reaching the real economy, the money ends up being printed and shared among banks and institutions. And they, of course, use that extra liquidity to profit. And what they basically do, instead of consumption, what happens is all that printed money ends up in the capital markets. So you end up in a scenario where you have stock markets going up while the real economy is going down. This is what we saw happening after COVID, right? We immediately had a recovery in the stock market, but we had a continuous recession in the real economy. And the problem is that all these uh, printed digital tokens that they call money doesn't end up in the real economy, but rather it gets stuck in the upper side of the pyramid, and they share the printed money, and they invest it in their own stocks or in the capital markets, and they hold the assets, so they benefit most. So what you end up with is, you end up with a scenario where you have the rich getting richer and the middle class basically gets destroyed, because the middle class is saving the currency that they're printing, and the middle class drops down and becomes even more poor, right? Unless the middle class is holding the same assets like the institutions. So I think this is very, very important to understand, because a lot of people don't understand the role that interest rates can play when it comes to the market reactions. So, to summarize one more time, when interest rates go down, currency becomes cheap, banks pump the markets, markets go up. If interest rates go up, currency becomes more expensive, hence more scarce, capital markets crash. That would be okay if the real economy would do well and they raise rates, right? And you have basically lower inflation, because if prices go up in the real economy, what you want to do is you want to raise interest rates so the prices stop going up. But if the real economy is doing horribly, then you make it even worse if you raise interest rates, right?
Exactly. So, in a natural recession, which is caused by some factor affecting the real economy, like a war or any other thing, um, production slows down, and what people will naturally do is to consume less. So people would just flock to cash and will spend less. So as the production goes down, people's consumption will also naturally go down. So this is actually a very good thing, because it allows riskier projects that are less valuable for the economy to go out of business, and only important things remain. And basically, this also balances supply and demand. So when supply goes down, people try to consume less. But uh, John Maynard Keynes discovered at some point that, okay, maybe um, we can manipulate this demand to, um, in an unnatural way, make the economy appear as if it's working very strongly. So what they recommended was that, you know, uh, governments and central banks stimulate demand when it has naturally fallen as a response to a recession.
Mm-hmm.
So then you get a condition where people, the production is down, but consumption is up. And who could have thought that this is going to be inflationary? So, um, and, and you know, you can't really force people to consume more, right? Because people also are intelligent. They will understand that this recession can lead to a lot of bad outcomes. So it's better to reduce their investment and keep more cash and reduce the risk and everything. For example, you might lose your job, so you need some cash to endure several months of unemployment. But governments don't like this because of what Keynes said. The way Keynes thought was that, you know, it's actually consumption that's the driver of the economy. So if people are consuming less, that's a horrible thing. So we have to force them to consume more. And like I said, naturally people don't do it. So we can force them to do that by manipulating the money supply. So once people don't, you know, spend their own money, we can devalue money, so they ultimately have less money in their pocket, and the value is moved to government's pocket. And then we can do anything we like with that money. And again, who can imagine that that money will be misused or lend out to more powerful players, and create inequality? So what you were explaining is basically the phase before all of this interest rate hike happens, is when they see a problem and they pump a lot of money in the way that I explained into the economy. And that pushes numbers to go up. A lot of projects will be started because there are loans available, right? So new companies will emerge, or bad companies
but
wouldn't fire people.
but loans not by market participants, but rather by a central bank providing basically fake liquidity, right? That's what it is essentially. It is fake
Absolutely.
liquidity.
This is a liquidity that's just on paper. Whereas if the economy was operating naturally, liquidity
Mhm.
would correspond to first having produced goods and services to the economy. So you would have unused capital somewhere, and then you would give loans in equal amounts. But in a case where you're in a recession, or generally, you know, that's our normal operating system, where people don't have a lot of savings, so there's no resources in the economy, and we're just increasing the paper money and handing out to people. So let's see what that happens when you do that. A lot of people think they are rich now. A lot of entrepreneurs get loans. A lot of horrible, awful projects that don't have, you know, a realistic chance of success receive funding. So all of these things would get started. They will hire people, new companies emerge, economic activity move on, and then they will buy stuff, and suppliers of those items will also see the market is strong, and they will inventories deplete, and everybody is like, yeah, looks like we are back on track and we are out of recession. Very good action from the government. I love these guys. They're managing everything properly, and their their approach is actually working. I love it. Then what happens is, well, obviously, uh, you know, sufficient inventory and capital was not actually there. So after a while, once all these newfound projects and zombie companies start continuing with their projects, they go to the market with the funds that they've received, and they will see that, oh, actually, damn, there aren't enough resources in this economy to support all the good things we want to do. So either they go bankrupt, either they slow down their projects, or um, you know, they will continue with it. And the effect of that is inflation everywhere. And when inflation goes up, all the calculation that the entrepreneur made in the beginning, you know, gets distorted. The cost of business goes up, and they can't repay the loan. They go bankrupt. People unemployed, and you go back to a self-inflicted wound, which is now, you know, hurting a lot of regular people that lost their jobs and thought they're actually benefiting from, they're actually getting rich, and they started spending just to find out that they're about to lose their job. And then we're back to this recession where it, you know, is politically very, very unpalatable, and whoever that's in power would really prefer this recession to go away. And of course, we can't recreate economic growth. So maybe if we can just kick the can down the road for a few years, it's good. Another president would have to deal with it. And that's what basically explains what we have done in the past 100 years.
So basically, capitalism starts with the capital accumulated by the economy or market participants. Then we basically end up in a system where capitalism is distorted by a central bank by taking over the role of determining what the real interest rate should be. And after that, the central bank decides how much money is in circulation and how much that costs. And that basically distorts the markets. And in a scenario of a real recession, what ends up happening is if there is not a lot of savers because the central bank, for example, has created a bubble and people have indebted themselves instead of saving, when a real crisis happens, just like, let me give you a very recent one, COVID, what happened was we had a real crisis and we were not prepared. And everyone was calling for the central bank to act because no one was prepared. If we had actually an economy where everyone was saving and interest rates were not artificially at zero, then we would have been prepared and we could actually afford to lose huge companies. We could actually afford to lose jobs because that should happen when there is a crisis. Just like there should be rain in a normal rain season, because if you don't have rain, you don't have summer. Like they coexist, they need each other, right? That's how nature works. But instead, because we were not prepared, because we didn't have capital in the economy, the central bank had to step in to pump it even higher, or to print even more artificial liquidity, to make sure we don't end up in a tsunami scenario where everything collapses. So it's a cycle of indefinite um, money printing that is trying to solve a problem by making it worse, right? So everyone who is saving gets punished, capitalism gets distorted and destroyed, and over the long term, poverty goes up and inequality increases.
Exactly. So let's assume that even with all the complexity in the economy, even the impossible task of figuring out the optimal interest rate was done by the central bank. Okay. Um, and so in that scenario, you can assume that they kind of play with the value of money and in the right way, in the right amount. And then once the recession is done and everybody has received those free checks, we will start accumulating capital again and raise interest rate to a much higher level, so that we pay back all the debt we created in the previous recession. But interestingly, the first part, that is creating free money for yourself and giving it to the cronies, that always happens. The second part, which is contracting the economy and loaning fewer, reducing the money supply and saving, that never happens to the same extent. So naturally, you will see that if this is just a one-way road to inflation, there is no deflation that's happening because it's painful. And when they're actually people are engaged with it, they aren't ready to go with with what it means, which means all those cronies would have to now see their asset prices crashing, and this never happens. To wit, you can look at the last 40 years of interest rates, and there was a time in late 70s and early 80s that rampant inflation caused the Federal Reserve to increase the fund rate to something like 19%, an extremely high number. And
That's not even
that
imaginable today, right? That's not even
oh, absolutely,
imaginable today. Yeah.
absolutely, we will have riots in the street if we are anywhere close to that. So that was actually successful because it killed the economic progress. it created heavy, deep recession, and then that was successful in reducing the inflation. So, and then immediately after that, of course, they dropped the interest rates to sub 10, somewhere around 8 or something, and then it continued the decline to 6%. And then they discovered that, oh, damn, a lot of companies are now heavily indebted. We have made money super cheap. Inflation is rising. So let's move it back up. And then so started moving it back up. And before they even reached 10%, the economy started showing signs of weakness and crashing. And of course, that's not palatable. And we want to help. We want to appear as saviors of the economy. So they reduced interest rates again. And nevertheless, we faced another recession in early 90s. Response to that was reduction of interest rates even more. So from 10%, we suddenly went down to 3%. And at 3%, okay, that was too low, created a lot of malinvestment. So they said, okay, it looks like this is starting to be too low, so let's bring it back up. But before they are able to even reach 7%, another recession happened, and that was the dot-com bubble in 2000. So, okay, so you're at 7% and recession happened, and they actually brought those rates down to levels not seen in the past 40 years, somewhere close to 2%. And obviously that pumped the market and temporarily solved the issue, but actually it was helping debt accumulate in the housing market. So a few years later, before they even try to raise interest rate back up to the previous level, like somewhere a little bit above 5%, the housing bubble burst. And then the response to that is to go even lower to actually 0%. And in around like 2015 and till 18, they started raising rates. And before they even get to 2% or somewhere close to that, they had to pivot because the response from the market was too strong. This time, people may think it's different, but at least when we look at history, every time they tried to raise rates, the system accumulated even more debt, and it became even more fragile, and couldn't tolerate anywhere near previous rate levels. So I guess this time they can't even reach the previous levels, and pretty soon, 0.25% is nothing, but as they keep raising it to closer to 1% or 1.5, we should see very, very bad things happening to the economy, including
because there's too much debt, right? There's
Absolutely.
just too much debt in the system.
Many parts of the economy now depends on debt. Corporate debt is at its highest as a percent of GDP. Government debt is at its highest levels in maybe 100 years or so. And as you increase the rate, a lot of these companies wouldn't be able to refinance or basically get new funding for continuing their operations. So old debt gets matured. You have to replace it with new one, which is now much more expensive and you can't afford. So, what do? Go out of business or maybe fire people, stop project. Same scenario happens to government. Government is actually the biggest debt holder. Our debt in the US is more than 100% of GDP, maybe more closer to 120% of the GDP. And that's basically you pay interest on that because you've raised it through the bond market, right? So you have to pay interest. As the Federal Reserve increases the rate, the reference rate, the yield on those bonds go up. So as previous debt of the government matures, they have to raise new funding from the market. They will have to pay higher percentages to people, and as a result, they already don't have sufficient income to fund the government. And what will happen? It will just get worse and worse. Tax receipts will go down. Government's ability to pay back debt will go up. So just mathematically, there's no way this system can tolerate higher rates and appreciating money. So what they will do is probably start inflation and start printing money after a while. So basically, they're doing a short-term experiment to kind of prove to the market that, yeah, okay, we can still increase our we are serious in increasing rates, so you should be afraid of indulging in too much investment in risky assets. But mathematically, this should all end in a quick and supposedly unexpected recession and downturn from the Fed's perspective, and reversal of the policy.
Yeah, I mean, also the side effects that should be noticed, I think, are in the quality of living, right? The living standards also decrease for the fact that because these recessions are not basically happening, or maybe let's put it the other way around, because central banks don't let the market correct itself, because actually every economy, just like nature, needs a winter time in order to have summertime, because they don't let the economy have a winter time, and they just pretend as if there is summer all year, it backlashes, because the companies that should have gone out of business don't go out of business temporarily. It looks nice because we didn't lose any jobs and anything in the economy, but over the long term, because these companies do not go down, you end up with a company that is actually not productive, and you make it bigger and bigger and bigger, and new companies cannot emerge, competition goes away, and monopolies arise. Although capitalism is having the reputation of being the one system that creates a lot of monopolies, which is quite interesting, because that's actually not the case. If you do a little bit of research, you start to understand that it's not capitalism, it's quite the opposite. Is crony capitalism that creates them, right? Because you don't let companies go down, you pump them with fake liquidity in order to save them, quote unquote, save them. But what you end up with is you don't let competition happen on a real market, and the production and the quality of the goods and services that they provide becomes lower, and the quality of living decreases over time. That's all the side effects that people are complaining about in the Western countries. Why is productivity going down? And live? I mean, usually when there's a recession, you should see a lot of companies going down, but you also see a lot of new companies emerging, right? And everything starts to get built from scratch. That's how it should work. But instead, we we have some banks that run the entire thing, and they just keep pretending as if there is no recession, and they keep printing and printing and printing currencies, and they pump the capital markets, but the real economy is still struggling, and you end up with these few large companies that control the whole market, which is crazy.
Yeah, I mean, the basically, I envision this like an athlete who goes to a tournament and overuses his capacity, and it needs some rest. As you engage in that resting, you kind of slow down your output, and you let your body to repair itself. Uh, what we're trying to do is basically saying that, okay, our athlete can run tournaments whole year round with no rest. Immediately after our athlete is tired and needs to take some rest, maybe can't run anymore, we will inject them with some kind of cocaine or whatever, um, anything that recovers them quickly, and everybody's like, wow, this was awesome, so thanks a lot, you did a great job, let's continue to another tournament. And every time our athlete has less and less resource and capability to continue. And as you said, the secondary effects of this are huge. It kind of distorts all the natural economic functions and incentives in the system. All of a sudden, horrible projects, not profitable projects, keep continuing. So the malinvestment, to borrow Hayek's terminology, the malinvestment that happens in that indiscriminate pump of the market eventually has to face the reality, which is there aren't enough resources for our project to turn a profit, at least sufficient profit to pay back the loan. So, and what we've done is kind of kept companies moving and moving and moving, and we have avoided bankruptcies to a level that these malinvestments are actually now a very substantial portion of the economy. So to face the reality, we should see mass unemployment and bankruptcies and all, but obviously that's not palatable. So they will basically they have pushed themselves into a corner where if they let the economy function properly, many of these companies that are actually not producing valuable goods and services for people have to go out of business. They are unprofitable. They are effectively zombies, and they're just hiring people for the sake of having hired people. They're not really producing sufficient profit to compensate.
Yes.
And the result of that is a huge portion of the economy isn't actually producing. Instead, they should have been hired by new and emerging startups that will actually start producing valuable goods and services. Instead, those resources are tied up in zombie companies. So just to give some validation to this, when you look at the ratio of zombie companies in the public space, public market, in 1978, or actually early 80s, zombie companies were somewhere like 2% of the economy. After every recession, they kind of go down. A lot of them go bust, but they kind of emerge stronger and more in higher frequency. Right now, it's well above 10%. So imagine 10% of your companies aren't value producing. So then what are they doing? They're just wasting economic activity. They're spending time and producing nothing. And as a result, everyone's life quality goes down. The additional goods and services that we could have had from other better startups is not happening. And old companies that are part of this broader system of part of the club, basically, they are allowed to survive and keep functioning and wasting economic energy. So this manipulation with money has far-reaching effects into every aspect of the society.
Yes. Sina, why don't we talk about the last bullet point, which is the effect of this interest rate, the artificial interest rate on the markets and Bitcoin, and then we finish it from there.
Right. I mean, just like money printing leads to a lot of leverage, which then pumps the traditional asset market, it has also pumped Bitcoin. Although Bitcoin isn't just pumped by this factor, it is also pumped by the fundamental growth of the network and the number of people who believe in it and all, because it's fundamentally a superior form of money. But on top of that, so you have this slow but sure increase in adoption and value. But on top of that, you have a lot of fluctuation that's coming from these short-term players and leverage players and all the Wall Street capital that has entered the space. That capital is weak and basically let us hand. And as all the things that we said happens with interest rate going up and capital credit and capital getting more scarce, people will pull money out of riskier markets like NASDAQ and the crypto space in general. And so what you will see is Bitcoin drops in tandem with the stock market, but that has fooled a lot of the market analysts into thinking, oh, Bitcoin is actually now highly correlated, 95% correlated with Nasdaq, and also, yeah, okay, it's the same thing, and
So
it's
it's
a
a
risk on
risky
asset.
risk on asset. Yes.
Exactly, but that's the way I see is, you have this slow and predictable trend underneath, but on top of that, it's like a river that's flowing very comfortably and smoothly at the lower levels, but on top you have swirls and weird, shapes up and down, and that kind of fools a lot of people, especially those who haven't done their homework, into thinking that uh, Bitcoin will basically perform very poorly in a contracting economy. But in fact, after all that initial, speculative money is gone out, and I mean, we have already had, a 50% plus drop. I'm not
Mhm.
exactly sure how further we would go, but pretty soon, I guess we're very close to that point where lettuce hands and short-term players and those who really don't uh, don't understand the value proposition here will get out. So you will probably see some kind of drop, but at the end of the day, Bitcoin is growing because of its fundamental value. So every day the liquidity increases in Bitcoin. Every day we discover new opportunities, especially with anything happening around the world, geopolitics that's happened. With the war in Ukraine and what happened to truckers and all kinds of other events were prove what we've been saying over the years about Bitcoin, value proposition. Every day, like, more and more people discover that some of those arguments were correct. We have actually, after that trucker convoy issue happened and their funds were frozen, we heard from a lot of people that said, oh, now actually I understand why we would need some kind of money outside government control. The same people would have said that, oh, why would you want any other kind of money
Yeah.
that's outside of the system? So, what I'm saying is, anything that happens in the world will show different aspects of Bitcoin usage because it's fundamentally better, and it's just a matter of time until people catch up. So you got that positive trend growing, and it doesn't matter what happens in the financial markets or what happens to Wall Street fund allocation. I would love for them to get out of the market and bring the price back down to a much better place where I can accumulate more. And what a lot of people would miss is that the long-term trend is just positive. So instead of running away in a tighter environment, you should actually be ready to accumulate.
So it's actually, the message is that Bitcoin is actually it's designed to be, or it is actually designed and is a risk off asset, and anyone who treats it as a risk on asset has not understood it. And over time, these participants are going to understand. And basically, I mean, the majority of Bitcoin holders do understand this. That's why we are at $42,000 from zero within 13 years, right? But you have a threshold. I call them basically, um, when you pour beer into a glass, you have the foam on top, and right below that, you have actually the beer, right? So I see the speculators. They're like the foam, and once we increase the amount of beer in the glass, the amount of beer goes up, but there's some foam at top that regularly, once the amount of beer goes up, the foam goes up, but the foam also comes down, but the base layer of the amount of beer in that glass goes up over time, right? That's what Bitcoin is essentially doing. And those people who do understand what we just talked about are, uh, just like you and I, are actually glad that the price goes down over the short term, because we can buy more satoshis and stack more for the future, right?
Yeah, absolutely. That's why they call these weaker markets frothy markets, because they look like froth. And I can't be happier about this happening, because uh, you know we don't just have a profit perspective. We want to participate in Bitcoin to fix the money, right? And then to see Bitcoin confusing and wrecking short-term players and those who really don't care about any of the values of Bitcoin, who just want to accumulate more dollars from trading it. To see them getting confused and wrecked is a nice thing to watch, and
It's quite
and
quite entertaining, right? It's quite
very
entertaining.
satisfying. Very satisfying, because uh, Bitcoin, has this way. I always say Bitcoin has this way of punishing those people who haven't done the homework, and hopefully a lot of people who kind of uh, buy the top and sell the bottom will, after some time, will come back again to this space with the perspective of learning, and really realizing what is going on with Bitcoin, and what kind of a revolution we are, is in front of our eyes, and we are kind of getting distracted by day-to-day price movements. So basically, one of the reasons we are working on Bitguide and to create educational content is to fix this, basically fill this gap, and let people really understand what Bitcoin is and what role it plays in the economy, to have a much clearer vision of future. And that's gonna naturally lead to you to basically lower your time preference, and don't look at the chart all the time, and don't react to the market movements, and rest assured that your thesis is just playing out fine.
Absolutely. Yeah. So I would say on that note, we can end today's discussion, Sina. So as you already mentioned, BitGuide is something Sina and I are working on. We offer educational content and soon courses. Give us a follow. Stay tuned for additional content coming. We do these rooms and these discussions on a weekly basis, every Wednesday actually. So give us a follow, give Sina a follow, and give me a follow. You can see me on Clubhouse as RK, and Sina is as Sina. You can give us individually a follow, and BitGuide, of course, the account, you can also give a follow. And the club, BitGuide, the club on Clubhouse, it's the greenhouse on top of this room. You can give the club also a follow. And whenever we do these rooms, you will get a notification and you can participate live. And if you miss a session, that's no problem. These are recorded. You can listen to them afterwards. And we even make them to podcasts. So you can listen to them on Spotify and on Apple Podcasts. Sina, thank you so much for your time today. It was amazing. I will see you next week. Take care.
Thank you very much. Thanks, everyone. See you next week.